Just look at the percentage of traders that lost money on popular trading platforms. On average, 75 to 80% of traders lose money. The four most dangerous words in investing are, this time it's different. But believe it or not, the biggest reason traders lose money is not technical analysis, candlestick charts, bad luck, lack of knowledge. By far, the biggest reason is actually poor risk management. Today, I'm going to show you what the biggest issue is when it comes to risk management, how to calculate your risk and reward, how to calculate realistic targets and stop loss prices, what all of these terms mean, and then how to decide how much to risk on each particular trade. I'm also going to share 3 bonus tips that will really help you when it comes to protecting your trading account and allowing it to grow slowly over time. My name's Sajad. I've been trading up for over 20 years, and believe me, the first few years were very, very difficult, and this was one of the biggest reasons. I just did not understand how to manage my trading account, and I actually blew through a couple of trading accounts as a result with leverage trading. Now, this story might resonate with you, and if it does, carry on listening, because this will really help you get back control of your trading. If you look at the chart here, you'll see on the top win rate. Now, basically what this means is the probability or the percentage of time you actually make a successful trade as compared to a losing trade. So 50% would be in the middle. So let's say you were to flip a coin on your next trade and decide whether to go long or short, which basically means if you go long, you predict the price is actually going to go higher. If you go short, you predict it's going to fall. Well, if you toss a coin, then your win rate will be 50% every time. But here we have the risk to reward ratio. Now, this is what makes all of the difference. You can see here, if it was a 1-to-1 risk reward, you would break even, meaning you won't make any money, you won't lose any money. But in all of the other situations, you're profitable. But this is where it gets interesting. You can see on the far left, win rate of 20%. What this means is you're right only 1 in 5 times. Only once in 5 trades do you get it right. And the other 4 times you get it wrong. But still, if your risk reward is favorable, you can still make a profitable trade and be profitable overall with that win rate. So let me show you how that works on a chart. For my charting analysis, I use TradingView. There's a link in the description below if you're interested in using this when setting up trades. This is a chart of Bitcoin. Now, when we're taking a position, long or short, basically there's 3 things we need to know. We need to know what our entry price is, we need to know what our target price is, and what our stop loss is. Those are the only 3 things we need to know. So let's use an example. Let's say I'm looking at Bitcoin right now, and I want to take a long trade, meaning I think the price is currently around 28,000. I think it's going to get a lot higher. I think it's going to go to, let's say, 35,000 or beyond. So where is our entry price? Well, it's at this level of 28,000. Where is our target? Well, if we scroll to the left, let's have a look at previous levels, just as an example. And let's say our target is this level here, 32,000, because that's previously where we hit resistance. So price might slow down there if it does indeed move up. Let's draw a line there, and I'll add a line at our entry price here, and I'll color the entry price as blue. And then we want a line for our stop loss. In fact, I'll change the top target line to green so it's easier to follow. And then we'll put our stop loss below the previous significant low here, which is around the 24,800 mark. Notice that price hit that 2 times and it held. So there's a good chance if price gets down there again, that if price drops below, we might get faster selling. However, it could bounce there and go back up. So we want the stop just below. So let's say around here, and let's color that in red. Now we've got 3 things here. We've got the target at the top again, we've got the entry here, and we've got our stop loss at the bottom here. Now we can either measure it ourselves or we can use the software. For example, on TradingView, you go to long position, and then you click on where your entry price is, and then you can extend the target upwards, and you can extend the stop downwards. So let's zoom into this and have a look. You can see that TradingView actually gives us the risk reward ratio here of 1.2 if we were to take this trade. So it's almost 1, which basically is a coin flip in terms of our risk reward. So let's call it 1-to-1, and let's see what our probability is of success if we keep taking trades like this. We look back on the chart, we're actually looking across the top line here. So basically, if our win rate is 20%, 30%, 40%, or 50%, we're not going to make any money at all. Only if we have a win rate of over 60% are we going to actually make anything on this trade. Now that's a massive issue. Most trading platforms have a good amount of commissions that you have to pay for every single trade. And you'll be buying on the spread, so you won't get the exact right price of Bitcoin, the live real price. You'll get something a little bit above or below when you're buying or selling your position. So automatically, this will affect your reward anyway. So the point here is when you're setting up a trade, to look at the risk reward and make sure it's worth taking the trade. Ideally, at least 3-1 would make it worthwhile to take the trade. So let's use an example. I'm going to actually move on to a weekly chart now so we could zoom out a little bit. Let's say we're a longer term investor. Because sometimes when you hold for longer periods of time and the trade is going in your favor, that's where you make bigger rewards and bigger gains. So let's say you're holding for the longer term and you're thinking of doing a year position or longer. Entry is the same, but this time what we'll do is the stop will be below the longer term significant low here of 15,000, so around here. And then the high would be back to the highs we saw in 2021. So let's say around the 68,000 mark where we could get resistance. So we would ideally want to take profits before the price pulls back. Now here, if you calculate the risk to reward ratio, we notice that it's 3.71, so nearly 4-1. That's much more favorable. That's where it would be worthwhile taking a position on Bitcoin right now, but a short-term position may not make sense, if you see what I mean. So what you might do with Bitcoin is wait for the price to clear 31,000 before seeing if there's a favorable trade that you might be able to set up. So you need to be very realistic in your targets and stops. And you can use technical analysis like I used here with basic support and resistance to help you set this up. Now I have many videos on my channel showing you exactly how to do that. By the way, if you're getting value out of the video, please consider liking and subscribing. I appreciate your support. Okay, so the next thing to consider is position size. Now this is actually an easier calculation than you think. So let's say we were doing it for this same trade. First of all, you have to take into account what the size of your trading account is. Let's use even numbers. Let's go for $8,000. Then you have to decide how much you're willing to risk on every trade. Now, if you've got thousands and thousands in savings and you make a regular income of $5,000 or $10,000 per month, then you're not fussed about the 1,000 too much. So you might be willing to risk a little bit more, maybe 10% or a little bit higher on a trade, especially if you've traded before. If you're brand new to trading and you don't have much in savings, you don't want to do that. So with the 1,000, you might only be willing to risk 5% or as little as 2% of the account because you're more looking at the long term. So let's use 5% as an even figure. So with 5%, what basically that means is we're risking, in dollar terms, we are risking $50. So we want this red area here to basically be the equivalent to $50, whereas the blue area would be more like 3.71 times 50. So we're talking about 175, approaching $200, that kind of level. So basically we're risking 50, and if it works out for us, we make 200. If it doesn't work out, we lose $50. That's kind of the area you're looking at in terms of risk and reward. And you can see here the stop in terms of actual points, how many points it is away. For Bitcoin, it's 11,109. And again, that's in dollars. So we could actually work out from that per dollar price of Bitcoin, how much we would be willing to risk. So it's basically $50 divided by that number, which comes to, and I use a calculator for this, 0.0045. I wish I could do that math in my head, but I can't. So 0.0045, that's per dollar point in Bitcoin. So when you're setting up your position, this is what you would be considering, this size of a position. And then just to confirm, you would multiply this by the number of points to get back to that stop loss price, and that should equate to around $50. That way you'll know your numbers are correct. And actually understanding numbers is another very important thing when it comes to trading anyway, so there's no better time to learn that. Next thing you want to do is come up with a trading plan. Now I've just got an example plan here. You can pretty much ignore this, but my point with this is actually journal your trade. Write down the market you're trading, entry price, target price, stop loss. Also a paragraph on why you are taking this trade. What opportunity did you notice? It's really important you stick to your plan. Discipline is key here. You need to focus on protecting what you have, so make sure you keep that in mind. It's a good idea if you're a complete beginner to start with what we call paper trading. Most platforms nowadays have dummy accounts, so you can trade real markets with live pricing, but without real money. Note though, your emotions will always be different when it comes to actual trades you make with real money. So even though you might be doing well on paper trading, it might be a little bit different afterwards. But still, the practice of risk reward, setting up trades, being disciplined in terms of taking profits when it's right to do so, taking quick losses, that all can be developed with paper trading. Okay, let's discuss some bonus tips now. The first one, let's say you've had several trades go against you. Let's say 4 in a row you've lost. Even though your setup was good, everything looked right, it didn't work out for you. It's like tossing a coin and getting heads 4 times in a row. It's less likely to happen, but it can happen. However, the first thing you should do is stop trading. Stay away from the screen, go back to it in a few days. Write down honest feedback on each trade. The most important aspect here is not why you took the trade. It's actually reflection on whether you stuck to your trading plan and whether you were disciplined in risk management. Because like I said earlier in the video, that's where most traders slip up.
Please stop.
Bonus tip number 2, avoid overtrading. Take a little bit of time and add up how many trades you actually placed in a week period. It's not only the excess commissions and trading costs that's the problem. Overtrading really stops you from letting your winners run, meaning you'll lose out on those big wins that can really help build your trading account. So those where you get 5-to-1, 6-to-1 and above risk reward ratio. There's a famous quote from Warren Buffett which says the stock market is a device for transferring money from the impatient to the patient. So just remember that. And bonus tip number 3, let's say you're getting into this situation where you're really struggling with your trading. One of the best things you can do is reduce your position and thus your risk size. So let's say you were risking 10% of your account, reduce it to 2% or even 1%. This buys you a little bit more time, gives you more opportunity to learn and understand what you're doing, and maybe if you're making any mistakes, and then you can build from there. If you keep it at 10%, you have a couple more losing trades, then boom, that's basically your account gone. If you found this video helpful, you'll love this one. Just click in the top right for more tips and tricks.